The Organization of Petroleum Exporting Countries left its forecast for growth in world oil demand unchanged at 3.4 million barrels a day in 2022, with total demand projected to average 100.3 million barrels per day. In its monthly report, OPEC said it raised its estimate of first quarter demand, but cut second quarter demand due to the resurgence of COVID-19 in China and ongoing geopolitical uncertainties. The forecast for non-OPEC liquids supply growth in 2022 remains broadly unchanged from the June assessment, despite upward revisions to China and Canada, and is now expected to grow by 2.1 million barrels per day to average 65.7 million barrels per day. To discuss this further, we have Uchenna Minnis, managing partner of Howard Minnis Asset Management. Uchenna, thank you so much for joining us. Good evening to you. OPEC having regained its global oil demand outlook for 2022, 3.36 million barrels a day. Is this consistent with the current market situation?
Yeah, I think so. I think they've looked at the trajectory and saying, well, on the back of post-pandemic, with business activities and economic activities going back to par, we expect demand to continue to shoot up, really. And I think that's the case going into 2023.
The growth, as far as growth demand for 2023, expected to slump to about 2.7 million barrels per day, rising just 2%. Well, what are the risks outlook to global oil next year, in your view?
I mean, that just continue to consolidate the fact that the oil market is in a bullish phase. I think that's not good generally, given the fact that a number of economies are still highly dependent on fossil fuel consumption, really. I think that will just continue to add into the inflationary pressure that we're currently seeing. As you mentioned earlier, we saw Ghana at a 19-year high. Even the U.S. really just released their CPI report too, also showing that it's trading at a 40-year high. The Bank of Canada just recently just hiked significantly by 100 basis points. So you see there is an issue when it comes to inflationary pressure, and with the dependence of fossil fuel consumption and whatnot, we expect that inflation to continue to peak going into 2023 for us.
Now, the head of the International Energy Agency, the IEA, Faith Birol, says the worst of the global energy crisis is likely still ahead, which is kind of bearish. Do you agree with that assessment?
No, I mean, I wouldn't say it's bearish. I mean, it's just trying to say we're still going into uncharted territories, really. If we're coming from uncharted territories, it's saying we're going to even more uncharted territories, really, given the variables that cannot be really said. And if you look at that report, there are two variables that were actually highlighted. The fact that you have improved economic activities and also some sort of moderation with geopolitical tensions, and those risks are very, very volatile risks. They are not exactly stable risks, as you would say. Are you assuming that the Russian-Ukraine war just goes back to that peace talks and all settlements? We're not sure about that. So I think what he's trying to reiterate is that going into 2023, we're coming to a place whereby we might see significant variables that are just going to be uncharted, and that might just affect how you can really place focus and plan towards the oil market, basically, Waters.
How much of the, as far as global oil, gas, and energy issues would impact financial markets?
I mean, it's quite significant. There's nothing you really can take away from this. I mean, when you start to break down the dependency, as I've mentioned, of fossil fuel as regards to economies, you see that inflation goes back to purchasing power, and you see that affecting financial markets, really, when you see people trying to shift their portfolio and their current investment from risky assets to maybe safer havens. Some people just take it out and just be on cash, because now they can't even afford to take those investments or go put their money in those investment vehicles. It generally just affects the general healthiness when it comes to the living of parties of residents of the economy, and also the investment health of individuals in the economy. So we don't expect this will be a significant effect going into the year, Waters.
What's your take on the U.S. dollar? Of course, saw the big news, of course, with the euro pretty much at par with the dollar, as far as the dollar with its peers. And what does that mean for the commodities play?
Versus, I mean, that is a very big issue. I mean, what has really happened is that I think where we're going to a recessionary play where it would be inflationary. What we've experienced going to global recession was a disinflation or deflation risk, recessionary risk. Now we're going to a recession period where we might see a a very expensive dollar, and that is like you're experiencing a double whammy effect, really. I mean, you're dealing with recession, and at the same time you're dealing with the US dollar at a very at the critical high level. What we're experiencing now, that is not trading at a 20-year high, if you check the report, and that is not looking good, really. And with the fact that the Federal Reserve will continue to hike, we're expecting another 100 basis points, because now the Federal Reserve they're caught up between the rock and the hard place, right? They need to fight inflation. And now, from a technical point of view and a growth differential point of view, the US dollar would continue to trade higher. So what that means for other asset classes, especially those asset classes and commodities that have been priced in the US dollar, that really would mean decreased purchasing power. And into frontier markets and emerging markets, I mean, that's just going to be very. It will be a big deal for this part of the markets, Roches.
Okay, I'm glad you mentioned that because you preempted my next question. As far as emerging markets are concerned, what would be the playbook when you put all this together? I guess the dollar, oil, and so on and so forth for emerging and frontier markets.
I mean, and you can see, right? I mean, it's let's use us as a reference point. I mean, you see where we are currently, given the fact that we're dealing with an exchange rate at abysmal level, and now that is not translating to the asset classes increase, price increase we're seeing in oil pricing. You can see how that is translating to the living conditions of the average Nigerian, really. And if you extrapolate that data into other emerging markets, other frontier markets that have their debts in USD, and you're dealing with a very expensive USD value, and now you're dealing higher prices. What you expect is significant inflationary pressure across the board, and I think we would get hit the most. It's like you're in a place where two elephants are fighting. We the grass would suffer the most, and that's where I can categorize what the frontier and the emerging markets are sort of are at the moment.
I want to ask you just a quick follow-up questions, one on emerging markets. On Nigeria, what you make of this news that I think about $2 billion was lost in June due to a 614,000 barrel shortfall. What do you make of the challenges with where Nigeria is now, the infrastructure issues, being able to pump out oil, the oil thefts? What's your read on all that?
I mean, it's clear. It's not just a local thing. I mean, OPEC is also wailing on the fact that the recent reports, the two laggards, that's Libya and Nigeria, that are not meeting up to their production quota. And Libya, maybe we can understand because they've been in war for a minute. But for us, I mean, we're part of the JMMC. The committee. We're supposed to be at the front trying to make sure that we meet our production quota. We're dealing with inherent risk factors here. We don't have the infrastructure to continue to maximize output, given the fact that, I mean, investors are saying, well, I don't think you're stable enough, I mean, to bring in my funds into this space or to this as an investment vehicle. Also, the fact that we have to deal with corruption through oil theft, really. So we're in that place where I expect Nigeria to continue to not meet their quota. I don't know how that can be worked on right now. I mean, if there's any immediate solution, maybe if we see a change in administration and we have a new person coming that's quite focused, maybe we can see all these things change, because they are really basic things, they are basic stuff.
Finally, 30 seconds or a minute if you can. Joe Biden, U.S. president, he's on his way to Saudi Arabia. He was in, I think, Israel. He stopped over in Israel today. Do you think Biden can get the Saudis to pump more oil to try to bring prices down? You think he'll succeed?
I don't think so. I think the only thing they can do theoretically for the objects will say they will see what they can do. See, Saudi needs to choose, right? And they've seen it, right? They're more scared of the Russians than the US. And I'll explain. And this has nothing to do with military partnership with the US. It's what we saw in 2020 in April, when these two behemoths went head to head to each other. We saw what oil traded at. And they understand now, given the fact that there is a proxy war between the US and the Russian, agreeing to US demand in that way, in that form, in that weight, will only continue to make the Russian really, really angry. So at this point, they just need to be diplomatic, cautious. They don't want to see oil trade into the negative territory like we saw 2 years ago. And the US would just have to deal with their own issues, really, in that way. I mean, if you want this to stop, then try to resolve this issue within the Russian and Ukraine. Just don't try to aid and abet it. So I think that's what the Saudis would do, but they cannot go by proxy against the Russians.
Uchenna Minnis, Managing Partner, Howard Minnis Asset Management. Thank you so much for joining us. Really appreciate your time.